Welcome to Chapter 14, Chapter 31 in the textbook, looking at monetary policy. And this is the overview of that chapter, looking at monetary policy and the role of the Fed in helping grow or slow the economy down. What are we looking at in this chapter? We're looking at money demand. We're looking at liquidity. How can we get money into the market? How can we take money out of the market? How does the Fed do all of these things using monetary policy? And then how do they make those decisions as to how much or how little do they turn on the faucet? We're going to look at all of those things as we discover monetary policy in this chapter. Thanks for joining me. All right, let's first look at the demand for money. What is money demand? Well, money demand is the idea of holding on to cash. What is the cost for doing that, in making that happen? How much are we going to be charging people in order to make that happen? And short-term interest rates are the best way to look at that. This would be something that has an asset maturity or a length of time in which you're loaning out this asset of 6 months or less in terms of what we're looking at here. So 6 months or less. These, if they were long-term interest rates, they'd be longer in terms of you'd be measuring it in years, not in months, in terms of long-term interest rates. So important to bear in mind that. And then we're looking at, so what does it cost us to loan this money out, to hold on to this money, and for people to borrow this money? We look at this in terms of the different interest rates that are available for short-term and long-term, and you can see here that we see that with this example, this table that shows you in June 2007 versus June 2008, the differences in terms of the federal funds rate from year to year. You can see the difference here in terms of what was going on in the market at the time. Heading into the crisis, you could see that they're lowering the rates on the money that's being held there, and this is significant because they're obviously trying to have an impact on what they're charging to the market in order to keep people encouraging them to loan out money and encouraging them to take money and put it in the market, keep money flowing, if you will, as we head into 2008, the crisis of 2008, 2009, definitely of concern there in terms of what we see. So money demand is essentially this relationship between the quantity of money that is demanded and the interest rate. So as the interest rate rises, the money demand is going to be much smaller, as you can imagine. As the interest rate falls, the demand for money is actually going to increase in terms of what we see here. So it is very much like a demand curve, inversely proportional. The higher the rate, the smaller the demand for money. The lower the rate, the greater the demand for money in that case. So if you think of it like that, in those terms, it makes more sense in terms of money demand. Think of it like a downward sloping demand curve. Now, the real money demand curve can change, that curve that we saw there, can change if we have changes in aggregate price level. If all of a sudden we have prices shoot up or we have prices shoot down, that can have a significant impact on the real money demand. Changes in real GDP, which tie in pretty closely to aggregate price level for the most part. If changes in real GDP are abrupt and significant, those can have an effect on the real money demand in the market. And changes in technology, as we know, always can have an impact on markets in terms of shifting out the curve, if you will. The PPF, changes in technology, can also change how much money is actually demanded in the marketplace. And then institutions that change, not just technology, but also how we use that technology, how we use money, how we see the demand for money. Changes in institutions, Krugman goes on to say things like shifting from using ATMs and dollar bill transactions to using more electronic transactions and having more online banking and electronic payments. Those types of things change the institutions in terms of how we use and demand money in that process. So all of this can move money, the money demand curve inward, leftward, if it's a negative response. It can move it outward or rightward if it's a positive response. So moving from MD1 to MD3 would be an inward or a leftward response to what's happening there in terms of institutions in a negative way. If it were a positive method, it'd be moving from MD1 to MD2. It'd be moving outward or rightward in terms of what we see here. And so this is going to shift the money demand falling would shift that curve inward. As I said, the increase in money demand would shift that curve to the right. Now, it's important to point out the velocity of money, and this is how money kind of turns over and changes hands. This becomes that money multiplier, if you will. The more people that are touching the money in terms of spending it and spending it in the marketplace, the more it turns over, the more it impacts real GDP, the more it impacts how much is actually being created in the marketplace, how much product, GDP, is being created, how much the price levels may be changing as a result of that. And so we use the formula of MV equals PY or PQ. In some textbooks, it's a Q. The idea of the quantity there, or the real GDP in terms of what we see. So the price times the GDP, or the quantity of what we're looking at here, that essentially is getting you to what we see in terms of money and its velocity. So the velocity essentially is the price times quantity divided by the money that we see here. And so this velocity tells us how fast are these dollars turning over? How fast is the money turning over? And is it turning over in a way that effectively is leading to greater real GDP? Or is it slowing down? Is it slowing down in terms of that GDP? And in looking at this, we are looking at nominal GDP divided by the nominal quantity of money. And so what we are seeing in that capacity is what impact is this having in terms of growth? If velocity is slowing down, then that tells us that our GDP is probably slowing down, or the prices may be falling, or concerns like that. If we're seeing velocity speeding up, maybe it's prices, maybe it's inflation we have to worry about, or maybe it's GDP growth that is taking off due to lots of money in the marketplace, like the stimulus for the COVID stimulus package, the American Rescue Program that Congress just passed last week. So all of those can have an impact in terms of that velocity of money as well. Now, with the velocity of money approach, as we see on the bottom here, the real quantity of money demanded is proportional to real aggregate spending. So the idea is the money times the velocity is going to be equal to the price times quantity. In terms of it's an equation. They should be equal. So when we look at the velocity of money times the money that's out there, it should be equal to price times quantity, price times what will be our GDP in terms of that price times quantity that we're looking at there. And so again, if this is increasing on the price and quantity, one or both aspects of that, then we're going to see that money is either increasing, or money and velocity is increasing. If we're seeing price and quantity fall, then we're going to see money and or the velocity also fall. So it's an equation. When one side goes up, the other one's going to have to go up in some way, shape, or form. So if we're seeing velocity increasing and money increasing, and quantity is unchanged, then we know it's prices that are changing, and that could lead to significant inflation and concerns about inflation. So that's where the velocity of money really helps us get a better sense of what's going on in the economy, just by looking at how much that is changing over. And that's a really important concept. There is an activity on MyMCPS Classroom, Activity 4-8, that goes into more detail on this. As I mentioned, the Q there in terms of real GDP. That is addressed in this equation. Y could be used the same for real GDP there, doesn't matter. But the idea is it is an equation. MV equals PQ, or PY in that case. And when one side goes up, the other one has to be going up too, because it is equal. And likewise, if one side is going down, the other one would be going down as well. Okay, now let's look at money and interest rates in terms of what we call liquidity, and the idea of being able to turn investments into money pretty quickly in order to be able to use them for money in things that we need to buy and regular run-of-the-mill items throughout an average day. So liquidity preference model is essentially looking at this in terms of what is the interest rate that is determined based on supply and demand, based on what money is supplied and demanded out in the marketplace. How easily is it accessible how easily is it available or not, and that essentially becomes our liquidity model that we see there. Now, money supply is going to show the nominal quantity of money with various interest rates in terms of what we see there. So let's see this graphed and graph it out for a moment. So we have the money demand curve. We saw that it's being downward sloping in terms of, again, higher interest rate, smaller quantity of money demanded, lower interest rate, much greater quantity of money demanded in this market. So the money supply curve, though, is going to be a vertical line. And this is determined by the Fed. So the money supply curve is chosen by the Fed. If the Fed wants to create more money in the market, the Fed can make that decision arbitrarily. If the Fed wants to take money out of the market, it can do so arbitrarily as well. So the Fed determines the money supply. Congress doesn't do it. The president doesn't do it. It is merely the Fed, okay? And that's why they are a regulatory body that is independent of politics, independent of what's going on in fiscal policy, because this is monetary policy. This is the Fed that is dealing with these types of things. So money supply curve, vertical line, and they can determine whether they move the money supply curve outward, rightward, or inward, leftward, based on if they're creating money, moving it outward, or cutting back on money. And again, this is, think of it like a faucet. They're turning on the faucet. Do they turn it on full blast? They're moving it to the right. This money supply curve. If they're turning off the faucet or turning it down, they're moving the money supply curve inward or leftward in terms of what we see there. So what we see in terms of that equilibrium interest rate is based on where the money supply curve meets the money demand curve. That determines the interest rate. That is the money that is out in the marketplace per the Fed's decision to supply this amount of money. Okay, so that's and again, they have lots of tools in the toolbox to do that. We'll talk about that in a minute. But this essentially is the money supply curve that we see here. And again, they can change that by moving it inward or outward based on rates, based on interest rates that we'll also talk about here in a second. So important to keep in mind that when you are looking at the quantity of money, we're looking for the equilibrium. Now, if they lower the rate, essentially they could be lowering the rate and thus creating more supply in the market and more demand in the market. And at that lower rate, they can also raise that rate and cut back on the money that's there. So if they're raising the rate and cutting back on it, that would mean they're kind of turning off the faucet. That would be at H here in terms of moving that money supply inward or leftward. If they're trying to create more money in the market, which is what they're doing right now, they're trying to keep rates low. They're moving that interest rate lower, and that's taking us to point L in terms of what we would see there in terms of the money that's being created. A lot more money created at those lower rates because it's encouraging more people to go out and take out those loans, more people to go out and take out those investments and make those decisions about refinancing your mortgage and whatnot and those types of things. So that's what we see here time and again. And that leads to key graph 24, which is essentially the graph of the money market. It includes the money demand curve, which is downward sloping. It includes the money supply curve, which is a vertical line. And they meet at equilibrium. A nominal interest rate. Notice this is nominal. Inflation is in this interest rate. And this is just a little I for interest rate. And the quantity of money, essentially QM, is the horizontal axis that we see here. This is the quantity of money that is demanded. And the money supply curve is chosen by the Fed. So if the Fed decides it wants to create more money, it can move this money supply curve. But the only thing that changes that money supply curve is the Federal Reserve. They are the only ones, the Federal Reserve Board of Governors. And they make those decisions. No one else. Like I said, not Congress, not the president. They can deal with fiscal policy all they want to. But monetary policy is the Feds and the Feds alone. So the Federal Reserve handles the money supply. And that's what we're going to see in all of these graphs. So what tools do they have in the toolbox? I call this the bird strategy. And it's really important because using the bird toolbox, they can basically grow the economy or slow the economy down. Okay? Why would we want to slow the economy down? Because we would want to keep inflation from getting out of control. Why would we want to grow the economy? Because people are losing their jobs and it's a recession and they're worried about the growth of the economy and the fact that there aren't enough jobs for people that want them. And that's where we are at the moment. So we're going to start with growing the economy by looking at the idea that the Fed is dealing with coronavirus, dealing with this recession, dealing with 10 million people out of work. The numbers this morning, 770,000 people out of work, higher than what was expected. It's supposed to be about 700,000. So almost 70,000 more people applying for benefits on top of the 9.9 million that were already out of work. So that number a little higher than people were expecting. Now, the markets didn't respond much to it today, but that doesn't mean that they will continue to do so. So we'll see what happens in that respect. But to grow the economy, the Fed first looks at bonds, and these are treasuries, securities, T-bills, whatever you want to call them. These are bonds that the government sells in order to fund things like bridges and schools and stadiums and other projects like infrastructure, to pay for our debt, to pay for the $1.9 trillion coronavirus stimulus package is a great example. These are how they pay for those items. They issue bonds. And in order to grow the economy, the Fed is going to try and buy those bonds back. So what they're not going to buy is the one they're just selling right now. There are lots of bonds that are out there. We have a $28 trillion national debt. So there's plenty of bonds out there to buy. But they are going to buy them. What are they going to do? How are they going to do that? Well, they're going to create money in order to buy them back. So they're going to, and they've said they're going to do this to the tune of about $140 to $160 billion. So they're going to basically issue money and give money to the institutions that are holding these bonds that they're going to buy, and that's going to grow the economy because the Fed is going to take the bond back. It's going to give the institution or investor that holds that bond the cash for that bond, and then those investors are going to go out into the economy and they're going to spend it. They're either going to buy more bonds or they're going to go out and spend it on other things that are going to help grow the economy. So the hope is they're going to go out and spend it in the economy. So the Fed buys bonds in order to put more money or to infuse money into the economy so that people will take that money then and go out and spend it. So by buying the bonds from the public, investors, investment houses, consumers, whatnot, they're putting that money back into the economy, and that is going to help the economy grow. Now, if they wanted to slow the economy down, they would do the opposite. They would actually sell bonds. And the reason for this is by selling the bond, saying, hey, we're out here, we're selling a bond. We're going to sell a bond, and we're going to take the cash from you. We're going to give you that bond. And with that bond, with that money, we've taken it out of the market. We've basically sold it to you. We've taken the money out of the market, and we've said that we are going to hold on to it until it is needed at a later time that we will have to essentially buy that bond back. So the Fed hangs on to the money. Why does it hang on to the money? Because later they know they're going to have to grow the economy again, and so they're going to have to go through this cyclical process all over again and go back to the grow side where they're going to have to buy bonds. They're going to give the money back out, and the process continues. So that's the approach that the Fed takes monetarily to the B in the bird strategy, which is bonds. Okay, so buy to grow, sell to slow is what I always tell students. Buy to grow the economy. You're going to buy them from the public in order to grow the economy. You're going to sell to slow the economy down, to keep inflation in check. Now, the same is true for the I, the R, and the D. We've already talked about some of these already, so this will be a little easier to go through, kind of as just a refresher. But the idea here is interest rates are the next item, and this is the target federal funds rate. And in order to grow the economy, the Fed is going to lower that rate. In lowering the rate, it encourages more people to take out that loan, and then they're going to take that money when they get the loan, and they're going to go out and spend it. That's going to help grow the economy. And as we know with the spending multiplier, that has an effect on MPC, so that if people go out and spend that money, it's going to have a ripple effect. It's going to have multiple effects over the economy in terms of growing the economy and helping the multiplier to spread to help get the economy back on track. Now, you guess where I'm going next, which is to slow the economy down. What are we going to do with interest rates? Well, we're going to raise them. And raising the interest rates discourages people from going and taking new loans out. It discourages people from spending money that probably isn't the best time to be spending money. They're worried about inflation. And so they're probably not going to be as likely to take out those loans when the interest rates are higher. So the Fed will raise rates when they want to discourage people from going out and taking out money. And this slows the economy down. And the same is true when we see reserve requirements. Remember, reserve requirements are basically the idea that the Fed requires that there is a certain amount of money that banks have on hand in order to prevent a bank run. We showed that clip of It's a Wonderful Life where there was a bank run. And the concern here is if you have enough reserve requirements in the bank, you're going to prevent a bank run. You're not going to have to worry about it. You'll have enough money in the vault, if you will, from reserves in order to meet any demands that customers have when they come in. And that's really the purpose, right? Is to make sure there's enough money that if somebody comes in and needs $500, you can pay them $500 without having to close the bank's doors in order to refinance and find more money. So the Fed is going to lower the reserve requirement if they want to grow the economy, because that encourages banks then to take all of the other money from deposits and go out and spend it in the economy, making loans, loaning out that money to customers, and encouraging them to go out and spend that money in the economy. That encourages growth in the economy. So they're going to lower those reserve requirements in order to grow the economy. They're going to raise those reserve requirements in order to slow the economy down. Now, we talked about the fact that the reserve requirements right now at about 10%. We talked about the idea that the Fed is probably keeping this as a backdoor item from any concerns that they may have about the interest rates and bonds that are out there already, and kind of keeping it as a break the glass and hit the fire alarm if we need to. So reserve requirements are about 10%, and so that is kind of an option they have in their back pocket to lower if they need to later in order to grow the economy if they need to, and they've used all the other tricks in the toolbox. So that one, again, reserve requirements also kind of on reserve from the Fed in terms of that 10%. And the last one is the discount rate. And this is what the Fed charges the banks to meet that reserve requirement in the overnight. It's also called an overnight window or an overnight rate. The discount rate essentially is a discount that the Fed charges to these banks in order to borrow money from the Fed or from another bank, another financial institution, in order to meet their reserve requirement, that 10% we were talking about. So this is pretty low, and it's usually right around, if not close to, if not the actual number of interest, the target federal funds rate, the interest rate we saw above. So the Fed is going to lower this number in order to grow the economy. It's going to encourage banks to keep less money on hand because they can easily borrow it for very low rates, and they can loan it out at much higher rates and make more money. So they're going to lower that rate in order to grow the economy. That encourages banks to loan the money out. Don't hang on to it. Don't keep it, because we can offer you a better discount rate at the discount window, the overnight window, in order to meet your reserve requirement, and you could still keep that money loaned out and make more money that way. So they're going to keep that rate low if they're trying to grow the economy, which is where it is now at 0.25%. And they're going to slow the economy down by raising it, and that would obviously discourage as many loans being made by banks as a result of what we see there. So these are the tools that the Fed has in their toolbox, what I call the bird strategy toolbox, in terms of trying to either grow or slow the economy down. Remember, in recessions, we try to grow the economy. In inflationary gaps or positive output gaps, we try to slow the economy down. So that's when each of these columns would be used. In a recession, like where we are now with 10 million people out of work, we would try to grow the economy. So we're going to try and do whatever we can in order to grow the economy to get our economy moving again and create jobs. If we weren't worried about that and we were in an inflationary gap or a positive output gap, we would want to slow the economy down because we'd be worried about inflation. We'd be worried about prices rising too fast, too much too much money out there, just like water, too much money out there chasing too few goods, and the concerns that prices would be rising dramatically. So we would slow the economy down by using those items in that red column. Okay, so let's look at about what effect this is going to have on the money supply looking at that model. So an increase in the money supply on the interest rate here in terms of trying to grow that economy. If we're going to increase the money supply, we're going to lower that rate. What it's doing is it's creating money. Okay, it's creating money in the economy by increasing the money supply. Just by lowering that rate that we were looking at in the toolbox, lowering that rate creates more cash for banks to be able to loan out. So it increases the money supply just by lowering that interest rate. The demand for money is greater here, the supply of money is greater here, and the rate is lower. So we know that more money is demanded by consumers and companies that are willing to borrow money at those lower rates. So this is increasing the money supply just by lowering that rate that we talked about that's in the Fed's bird toolbox. That really is the driver here. So that increase in the money supply is essentially lowering that interest rate, and that is how they move the federal funds rate and increase money supply in the markets. You can see here in terms of how the Fed moves those rates. You can see some of these planned meetings versus unplanned meetings. Obviously, a lot of planned meetings as they hiked rates back in the 2000s, concerned about inflation. Then the financial crisis hit in early 2008. They were concerned, had an unplanned meeting. They cut rates. They had planned meetings. They cut rates again. They continued cutting even when they didn't have meetings. And I love this graphic because it really shows the struggle that they're having as the financial crisis looms. And here they are trying to deal with a financial crisis. They're cutting rates, trying to get them as low as they can, and it's helping marginally, but there are bigger problems with the financial industry, with the housing industry, and we know all about that in terms of the mortgage crisis and other things going on that they're trying to address. They tried to bail out banks. They offered money. There were a lot of other things going on here. But the point is, those rates never came back to those pre 2008 levels until well into the Trump administration, to well into the post Obama years. So what we see here is Obama's elected, the rates are low, they stay low because they're trying to get the economy back on track, and then there's a lot of quantitative easing, which is essentially a lot of money being infused into the marketplace, trying to address this and get the economy back on track. It took a while. Remember, there are lags. An economy that is humming as loudly and largely as the U.S. economy is, it's really hard to turn that ship around. And so they left rates low, and then during planned meetings, we can see in 2016 and 17 and 18, they started raising those rates little by little, a quarter percentage point here and there, trying to keep inflation in check, trying to keep inflation at bay, and concerns about that. And then with the pandemic, you can see unplanned meetings. They're dropping the rates as fast as they possibly can because of the crisis. And that's kind of where we are today. The target federal funds rate is anywhere from 0 to 0.25%, and it's been there for a year now. It's been there since March 2020. It is still there in March 2021, and the Fed Chair Jerome Powell yesterday, at the end of their 2-day meeting, said they're going to leave them there, and it's probably going to be there for a while. So that the concern is that they're probably not going to look at raising those rates until like 2023. Late 2022 or early 2023 because of the lags, it's going to take a while to get the market back on track. And so that's what we see here, and I think that this visual really helps tell that story. Okay, so pushing that interest rate down to that target rate. Remember, there's only so much you can do there, especially when you're down at zero. There's nowhere else you can go. Then we get into the 90s, like Japan and the liquidity trap, if you will, in terms of that. So if we're pushing that rate down, we can also do this not just through interest rates, but also through buying bonds, the open market purchases, remember. So in doing this, buying bonds, we're growing the economy. The rate can fall. The idea the money supply is growing because we are buying bonds. We're putting more money into the market through that and pushing down that target rate. To what we see here, that is the way they can use bonds in that toolbox to grow the economy as well. And again, that target federal funds rate right now is at 0.25%. It has been there for a year, and that is their target. And they've said they have no desire or intention to move it from there until we are out of this crisis. So that is where it will be. But that also means that they have nowhere to go in terms of that. That tool in the toolbox has been used. So you've got to go through other methods. You've got to use more asset purchases in terms of buying assets that are weighing down the books, the financials of institutions. The Fed has said that they are willing to do that. They're willing to help that out in that regard. They're encouraging Congress to spend money on the fiscal side of things. They're encouraging in that buying bonds category in order to try and grow the economy through what they're doing here. So this expansionary monetary policy that we see either in lowering those interest rates or in buying bonds is moving the money supply curve from MS1 to MS2. This leads to a lower interest rate and a greater quantity of money in terms of what you see here. So buying bonds is creating money in the market. Lowering the interest rate also is going to have the same effect of lowering that rate or pushing down that interest rate is going to create money in the market as well. But buying bonds and lowering interest rates, two tools in the Fed toolbox in terms of increasing the quantity of money that's out there, increasing the demand for that money, and at a lower rate as a result of both of those, the B and the I in the bird toolbox. Now, pushing the interest rate up, again, we're talking about growing the economy in bad times. What happens when we get to good times and we've got to slow things down? We've got to turn the faucet off or at least slow it to a trickle. So this is where we want to push the interest rate up. And we're going to do the opposite of what we did in the last scenarios. So in this case, we're looking at an open market sale. We're going to sell bonds in the open market in order to push the interest rates higher. We're going to cut back on the money that's in that supply. So by selling bonds and issuing cash for them, we're taking the bond back. We're giving people the bond. We're taking the money from them and taking the money out of the economy. So that's essentially turning off the faucet of money that is flowing. This is encouraging people to take a closer look at whether they should make that investment. As the rates go up, people are like, oh, well, maybe I won't buy that new house. Maybe I won't take out that loan for that new boat. Maybe I won't make that new investment of that new manufacturing facility that I wanted. And that leads to the contractionary policy that we see in key graph 26. So by cutting back on this through the sale of bonds, selling those bonds, taking money out of the economy through the sale of those bonds, in institutions, investors, consumers, they're buying the bonds. The Fed is selling the bonds. So again, sell to slow the economy down. They're taking money out of the money supply. That's leading to a higher interest rate that we see here and a smaller quantity of money. All right. The other way that we talked about this earlier in terms of what can shift money demand, things like aggregate price levels, real GDP, looking at changes in technology and changes in institutions, all of these can shift money demand. Now notice it's not changing the quantity of money, it's changing the demand for money. So in this case, if there is a change in technology or institutions, for the positive that's moving the money demand curve outward or rightward, that's leading to a higher interest rate. But notice that the quantity of money has not changed, which is why that interest rate is going up, because the money supply is no more or less. less. It's the same. But the demand for money has increased, so that drives up the interest rate. The interest rate is going to be higher there. As households are deciding if they're going to spend more money on these items, they're driving up that rate. So the idea of a hot economy driving up inflation is going to drive up these interest rates. And that's going to ultimately, what it will happen next is people will make decisions about whether or not they really want to make that purchase. So it will temper, kind of as an automatic stabilizer, if you think about it, kind of temper the decisions of people as to whether or not they really want to make that investment and take out that loan. At a higher rate, many of them will not. But that's what we see here in this key graph 27. The idea is money demand shifting outward. That's going to lead to higher interest rates. And the opposite is true if we look at key graph 28. Here we have decreased demand within the money market. You have a situation in which money demand now is moving inward or leftward. This could be because of GDP is falling or price levels are falling. There's a problem with institutions, or there's a technological glitch or a virus or something, a computer virus or something that has negatively impacted the technology. And as a result, the demand for money is moving inward or leftward. And so this is going to lead to a lower interest rate. Now notice the money supply has not changed. The quantity of money has not changed. Only the demand for that money has changed. And by moving that inward, it's driving down those rates. Now, what is it going to do next? Well, lower rates is going to encourage more people to make those investments. So the concern is, will they make that investment at a lower rate if it means that that the recession, well, I could lose my job. I don't want to make that investment now. Even though they are lower rates, I'm worried about whether I have a job to be able to pay that loan back. So these are kind of the things that are very cyclical in nature to be thinking about in terms of what's the next step based on what we see here. So with money demand moving inward, it's driving down the interest rate. Money supply or quantity of money is unchanged, but this is what typically would happen in a recession. What would happen when the Fed would want to step in and grow the economy by increasing the money supply. Again, that would drive rates down even further, which would encourage even more growth and get hopefully the economy back on track. But that's kind of cyclically what's happening in this money market graph. Now let's talk long-term interest rates for a second. Remember, they don't move with short-term interest rates, which is mainly what we've been talking about for the most part. But it's important to keep in mind that if investors are looking at short-term rates rising, they may buy those short-term bonds. They may buy bonds at a shorter period of time. They see a better investment in that regard. So the whole idea is the expectation game is really the driver here of short-term rates because people are looking at, well, what's the average expectation in terms of what's going to happen in the long-term market? How is that going to affect short-term rates? So while they aren't necessarily intrinsically related, we do know that investors tend to look at short-term. They're looking at what's the investment that I can make money on now, and then how is that going to how does the long-term outlook affect what's happening in the here and now as well? And that's important to note as we look here. So if the Fed decides to reverse course, and we've seen them do that in the 2020 in the year 2020 with the pandemic and the coronavirus, we can see that they make those decisions. I like the other graph better than this one, but the idea is the same. They can change that federal funds rate in terms of looking at whether they're raising or lowering that rate and affect the money supply and thus interest rates as well as growing or slowing the economy down. And that's what we see in that particular marketplace. So expansionary policy, they're trying to grow the economy, trying to increase aggregate demand. How do they do that? Well, by lowering interest rates and increasing the money supply. They're going to encourage people to invest. An increased money supply is lowering the rate, as we saw with the money demand curve. That lower rate then is going to encourage more people to take out loans and make investments. That is going to encourage aggregate demand to shift rightward, which is going to get our economy back on track. If we had problems where the economy was too hot too fast, then we would look at contractionary policy, the idea of cutting back on the money supply, selling bonds, and slowing the economy down by leading to higher interest rates. That's going to discourage a lot of investment spending. It's going to discourage people from going out and making new investments and spending lots of money because they're concerned about whether they're going to have the money to pay it back. And so that's going to shift AD inward or leftward as a result of what we see there. And that has an impact on the market in terms of slowing things down, keeping the economy in check, and keeping inflation at bay. Again, to expand your expansionary policy, the idea, the goal is to increase aggregate demand. For contractionary, the goal is to decrease aggregate demand because you're worried about the economy getting too hot. So that's really the unique differences in the drivers here of expansionary and contractionary policy in using monetary policy to do so, that bird toolbox that the Fed has at its fingertips. So expansionary policy, again, increasing aggregate demand. Contractionary, reducing that aggregate demand. And we do this through what we looked at in the last chapter in terms of selling securities, treasuries, T-bills, bonds, whatever you want to call them. So the idea here is on the left side, the Fed is going to buy to grow the economy. They're looking at buying bonds. They're basically taking the bond, giving the bank money. The bank is then going to take that money and go put it out in the marketplace. They're going to make loans with it. Okay, so the bank is going to give the Fed the T-bill. The Fed is giving the bank the T-bill. The Fed is giving the bank the money. The bank gives the T-bill to the Fed. The Fed gives the bank money, and then the money is loaned out to customers in order to grow the economy. So buy to grow the economy. Now, on the right side, we see the Fed is selling securities to slow the economy down. So in this case, they're going to take money from the banks, and they're going to give them treasuries, bonds instead. That's going to take money out of the economy, and that's going to lead to the contractionary monetary policy we were talking about. If there's less money out in the market, then there's less aggregate demand. And that's going to slow the economy down. So sell to slow, buy to grow, sell to slow in terms of what the Fed can use there with bonds. So for bonds, the B in the bird toolbox, buy to grow, sell to slow. Now, expansionary policy and contractionary policy, how does that play out in terms of the graph? What do we see here? We see expansionary policy is designed to shift aggregate demand to the right, where contractionary designed to shift aggregate demand to the left. And by using those policies, again, buy to grow here on part A, sell to slow on part B, we're driving that aggregate demand the way we want it to go. And the Fed is going to use that time and again to try and either grow or slow the economy down. We see it playing out here in terms of the driving up or down the federal funds rate, the interest rate, the I in the bird toolbox. This is important because, again, that's also going to drive the D, the discount rate that they're offering banks to borrow, the D in the bird toolbox. And that is going to, again, grow or slow the economy depending on whether they have to raise rates or cut rates in order to help the keep the economy humming. The idea here is they're looking for balance. Okay, that's the most important thing, is they're looking for balance. So if they buy to grow or they they lower rates in order to grow the economy, they're not just going to lower them and keep them there. They're monitoring this. They're constantly monitoring this, and they have meetings in Washington 8 to 10 times a year where they look at this in terms of, well, what should we do with the rate? Should we leave it there, or should we raise it? Should we lower it? What should we do? And so they're looking at this all the time. They're looking at data in their regions of the country. They're looking at this overall in terms of what the country is experiencing and making these decisions on a monthly basis, trying to keep the economy humming in that balance, in that equilibrium that we talk so much about. And the important thing here is, again, the reason why they'd want to raise rates or sell bonds to slow the economy down is because they're looking at inflation. They don't want inflation to get out of control. And this is called inflation targeting, where they're really trying to focus on policy that is going to keep the economy humming without it getting too hot. They don't want the economy to get too hot. If it gets too hot and inflation gets out of control, then that can lead to recession because prices are skyrocketing. People don't have enough money. Too much money chasing too few goods leads to all kinds of problems and can also be recessionary. So there is a balance, and again, they're striving for that equilibrium. Now, in the long run, monetary policy, in short, monetary policy doesn't have an effect in the long run, okay? So we're going to see lots of economists, and again, you ask 10 economists a question, you're going to get 20 answers. But the idea here is that it is what we have called monetary neutrality. The idea in the long run, what we're doing here is in the short run. It's designed to have an effect in the short run, not so much in the long run. So if we look here at aggregate demand shifting outward, we know that by increasing the money supply, we're lowering the interest rate. That is encouraging aggregate demand. We know we've got sticky wages here in the short run, and we know that ultimately those sticky wages aren't going to be sticky. Those are going to lead to higher prices in wages because we're having to pay more workers. So that shifts SRAS leftward or inward to a higher rate, a higher price level, on back at full employment. So those sticky wages no longer from E2, no longer sticky at E3. We have a higher price level, and we're back to real GDP. We're back to full employment in that regard. Full employment being at 5% unemployment or less, and that's the idea we're looking at there. Okay, so when we're looking at the Fed trying to buy bonds or sell bonds or increasing interest rates or lowering interest rates, their goal is to bring the economy back to full employment. If it's an inflationary gap like we see here, they're trying to bring it back to full employment, trying to temper that inflation, but trying to do so in a way that brings us back to full employment. Same thing is true if it were going to be a negative output gap or a recessionary gap, trying to move the economy back to long run, back to full employment. But again, as I said, in the long run, there's really no effect. It's what we call monetarily neutral. Okay, so no real effect on the economy in terms of what we see in the long run. However, these do have significant impact and effects in the short run. And as we can see, buying bonds to grow the economy definitely helps encourage investment and spending and consumer confidence and helps grow GDP in the short run. It may not help in the long run, but it definitely puts food on the table for the families that need it in the short run. And that really is the driver of why monetary policy is so important here from the Fed, using that bird toolbox that we've talked about. Okay, so long-run determination of interest rates, we can see here increasing the money supply lowers the interest rate in the short run, but it's also going to lead to higher prices, which means then that they're going to have to raise interest rates because there's too much money out there, and ultimately that leads us back to a situation in which what are they going to do? Well, they're going to cut back on the money supply, and the concern is it's going to lead to higher rates, and so what are they going to have to do? They're going to have to go back through the process all over again. So short term, it has more of an effect, not so in the long run. The idea there is in the long run, you're going to end up back at the original level. There's a great activity on this if you need it on the MyMCPS Classroom modules for this unit. It is activity 4-4. It's all about the money market, taking you through a lot of those steps, and I think you'll find that one helpful. There's also one on monetary policy that we talked about in this chapter, 4-7. That kind of takes you through a couple of those scenarios, so that would be good. I know MindTap also had that, the Chapter 34 MindTap, and also this take-home quiz on this chapter is critical in terms of taking you through a couple of those scenarios that I think you'll find helpful. I will not be going through the summary. You can definitely check out the notes in terms of going through all those details. There is an explainer at the end of these slides that I think you'll find helpful. There are links to different resources from people like ACDC Econ and Jason Welker and Khan Academy and so on. I highly encourage you to check those out on monetary policy. Get a different perspective in terms of explaining this and in terms of taking you through it. I hope you found this helpful. Have a great day. Good luck on the upcoming assessment, and we will see you in class.